Today, we're going to look at how you're taxed if you made all your money on earned income, like having a job, versus how you're taxed if you made all your income in qualified dividends. There's a difference, and we're going to break it down for you. For this scenario, we're just looking at federal taxes. It's too much to go into all 50 states. They're all so very different. Some have state income taxes, some don't. Some tax dividends, some don't. But we will do a side-by-side comparison of earned income versus qualified dividends. Now, the first thing to note, there is a difference between qualified dividends and ordinary dividends. Ordinary dividends are taxed at your regular tax rate, the same as earned income. Whereas qualified dividends give you a more favorable tax rate. For a dividend to be considered qualified dividends versus ordinary dividends, you have to own it for a certain amount of time, usually over 60 days. There's very specific requirements there, and you should definitely look that up or talk to a tax professional if you have questions about that. For our example today, we're going to look at $100,000 in earned income versus $100,000 in qualified dividend income. We're assuming this taxpayer is single, has no dependents, and these are qualified dividends, of course. In this taxpayer will be taking a standard deduction. For the first example, you work a job, you earn $100,000 a year in earned income. This is your salary, your wages, $100,000. Using the 2025 tax rules, our standard deduction is $15,750. This makes our taxable income $84,250. The United States uses a graduated tax system where you don't pay just the top rate. You pay at different levels. Here's the breakdown of our federal tax. We're going to pay 10% tax on the first $11,925. That comes to $1,192.50. Next, we're going to pay 12% on the income between $11,926 all the way up to $48,475. That's a total of $4,386. But we're not done yet. Because we made more than that $48,475, anything over that is going to cost us 22% tax. On our remaining amount of our taxable income, we have $35,775 of that remaining. That's going to be taxed at 22%, which gives us a total of $7,870.50 of tax at that level. Next, we need to add up all these brackets together. When we do that, we get a total of $13,449. That's our total of federal income tax. However, we're still not done yet. We have to pay Social Security tax, which is taxed at 6.2%. And that tax is taxed on our full $100,000, not our taxable income, but the full gross amount of money we made, which breaks down to $6,200. We also need to pay Medicare tax, 1.45%, and that too is taxed on our full gross amount of $100,000. That will be $1,450. Now, when we add all this together, we get a total of $21,099 that we have to pay in taxes. That makes our effective tax rate 21.1%. Now that we know what our effective tax rate is and we know how much we're going to pay on our earned income, now let's take a look at how much we'll pay on qualified dividends. For this example, we're assuming that we made only money in qualified dividends, no other income. Same as before, single, taking standard deduction, and this is how it's going to play out. We have $100,000 of gross qualified dividend income, and we subtract our $15,750 for standard deduction. That gives us our $84,250 of taxable income, just the same as it did for our earned income. Next, we're going to look at the tax brackets for qualified dividend tax rates. And this is where you'll start to see the savings. Qualified dividends are taxed at either 0, 15%, or 20%. Your first $48,350 are taxed at 0%. You pay no tax. Over $48,351, all the way up to like $533,000 and some change, that is taxed at 15%. And that is what we got to pay on our remaining amount. For our next $48,351 all the way up to our taxable income of $84,250, we just subtract those and that gives us $35,899. That is the amount we have to pay 15% tax on. And that works out to be $5,384.85. Because we're getting our income here in qualified dividends and we're not earning an income, we don't have to pay Social Security tax and we don't have to pay Medicare tax. So in our earned income example, that was a total of $7,650 that we don't have to pay now. So that's all we're on the hook for from a federal tax standpoint. So that means our total federal tax here, even including Social Security and Medicare, is just $5,384.85, which means our effective tax rate here is 5.384%. We'll round it up to 5.4. So a 5.4% effective tax rate versus a 21.1% effective tax rate. So which is better? Clearly, it's better to earn all your income and qualified dividends. However, it may seem easy, but it's really not that easy. In order to earn $100,000 in qualified dividends, you have to have a substantial amount of money invested. We'll look at a couple examples of that in just a moment. One thing to keep in mind is if you make over $200,000 a year in qualified dividend, you'll have to pay what's called a net investment income tax. And that is 3.8% added on to what we just talked about. Keep it under $200,000, you don't have to pay that. Before I give you a couple examples of different ways you can earn $100,000 in dividend income, I just want to point out that the reason dividends are taxed at a lower rate is because it's already been taxed. The whole reason you're receiving dividend income is because you are an owner of a company. You own shares of that company. The company was already taxed once before, and then when they're sharing those revenues with you, they're sharing revenues that had already been taxed. So these revenues are double taxed. And that's why they give you it at a lower rate. Technically, it shouldn't be taxed at all. Because I promised you, let's take a look at how much money you would have to have invested in a particular company to earn $100,000 a year in dividend income. Let's look at Coca-Cola. You would have to have $3.28 million invested in that company in order to receive $100,000 a year in dividend income. Like I told you, it wasn't a cheap amount. And that's because Coca-Cola has about a 3% dividend rate. There are other companies that have higher dividends, but Coca-Cola has consistently paid dividends and raised their dividends each year for many, many years. I would never recommend you putting all your eggs in one basket, and if you just had $3 million, I would not put $3 million in Coca-Cola stock alone. But I just wanted to throw out an example so you understand. Hopefully this explains the difference between earning an income versus investment income. Investment income is taxed at a lower rate. If you enjoyed this video, please hit that like button and please subscribe.